Everybody's looking for signs about what's going on in the economy. Obviously, the yield curve inversion has been a recession indicator sometimes, but that's based on historical precedent. You say what's going on with the consumer, which is, at least here in the U.S., about 70% of the economy, and what's going on with real wages is something we should pay more attention to. Can you explain?
Definitely. I mean, what we're looking at in the U.S. economy right now is the very rapid pace of interest rate increases, right? The Fed is very committed to doing what it needs to do to bring inflation down, keep inflation expectations contained. We're already seeing the impact on the housing sector. It has retrenched pretty substantially in recent months. Now what we're looking at is how is the consumer, how are households really responding to these rate increases? And the consumer has been surprisingly resilient. We've seen real disposable incomes decline in recent quarters. We've seen real wages that are still deeply negative, but consumers have continued to spend. However, that trend has been decelerating. We expect still positive consumer spending in the third quarter, but at a slower pace. What we're also noticing is, where are the strains appearing? Consumers are, relying more and more on credit card debt. Revolving credit has gone up. It's at record levels right now. And while delinquency rates are still low, we have seen a tick up, especially for lower income households. And then, if those strains become more broad-based, that'll have implications not only for consumer spending, but just in general, the trajectory of the economy and growth.
I want to talk a little bit more about that. I know that's something you're really highlighting. Another data point you're looking at is delinquency rates, especially when it comes to lower income families. One thing your research found, this comes from Fed data, is that household debts increased $2 trillion from Q4 of 2019, obviously pre-pandemic. What does that say potentially about the direction of the economy and the direction of the consumer?
Well, that's exactly what we're trying to figure out is what is the staying power of the consumer? How much strain are households under because they are paying so much more for food, so much more for rents? And what we're finding is that we are seeing a deceleration, but still positive. We're not seeing an outright contraction. And what we're seeing on the labor market side is obviously positive, still very strong job growth. And, restoring incomes even though wages are not keeping up with inflation. But, overall, there's no indication yet that the consumer side of this economy, which is what drives growth, is about to collapse. But, beyond September, we don't really have a good handle on, what the response will be as the Fed continues to raise rates at a very rapid pace. And it actually wants to soften the labor market. So, that's something that we are really trying to, focus on to see what's going to happen in coming quarters.
So in recent days, we heard Fed officials come out, basically say that, their plan to cut inflation may lead to job losses. It may lead to some pretty dramatic economic slowdowns. What's your base case for the markets if the Fed stays on this path?
The continued volatility. I mean, the Fed is very clear. And, if the markets didn't get the message at Jackson Hole, they certainly got it last week, because we saw in the dot plot, not only are they going to raise rates and they're going to continue to do so at a rapid pace, but they're going to keep rates higher for longer because, that is what is needed. They want to make sure that they don't just get to a point where inflation is lower. They want to make sure that inflation stays lower. So I think this just means a lot of volatility because we are moving from a very low interest rate environment to a new, sort of pre-financial crisis type of environment where rates are going to be higher and the Fed and other central banks certainly not about to back off.